Hey, what's going on everyone? It's Griffin here and I hope you're all having a fantastic day as always. Now, in today's video, I wanted to take a step back from all of the growth and penny stock videos that we've been speaking about lately on the channel, even though granted these stocks have produced some pretty stellar returns for us over the course of 2020, but I wanted to take this opportunity to circle back to some really great dividend stock picks that you can add to your dividend portfolio for great cash flow over the course of 2021. And I mean, at the end of the day, who doesn't like consistent cash flow coming into their portfolio regardless of what's going on in the economy and in the stock market? You may know that I personally have 3 different portfolios, one for growth stocks, one for ETFs, and then also one for dividend stocks. So why speak about dividend stocks right now though? Well, this actually used to be a topic that I would speak about quite regularly on the channel, and I was recently just looking at my content that I've been putting out, and I also recently watched a video by fellow finance YouTuber Joseph Hogue, and it had me thinking that we're kind of severely lacking right now on the channel with some dividend content. So I thought this would be a great opportunity to circle back to dividend stocks that would be great additions to any dividend investor's portfolio for the course of 2021. Now, surprisingly, yesterday I also saw that Daniel Pronk released a video speaking about dividend stocks that he's going to be holding over the course of 2021, and so incredibly coincidental that he also mentioned Joseph Hogue, and I had already written this entire video out by the time I saw that, so I immediately texted him. You all know that we're friends, we've done collabs before, and we've kind of just had a good laugh about how weird that is, but obviously we're on the same page for this content once again. So anyways, all this to say that in today's video, 4 dividend stocks, each operating in a different industry for some diversity in the content here. 3 of them are my own picks, and then the last one is going to be a pick from Joseph Hogue's video that I personally thought would add a lot of value to my video and for the audience here. Joseph has a great channel also focusing on personal finance as well as stocks and stock market related content. If you don't know him, definitely check him out. I'm going to leave a link down in the description to his video because obviously, I was inspired by his video here, so props is due where props is due. With that said, I really hope you enjoyed today's video. If you do, give it an early thumbs up and let's get right into the first dividend stock. Alright, so jumping into the first dividend stock on today's list here, this is a company that operates in the energy industry, and this is a stock that I have been requested multiple times on the channel over the past 6 months or so. The company I'm speaking about is Enbridge, ticker symbol ENB.TO on the Toronto Stock Exchange and ENB on the New York Stock Exchange. Out of all the industries in Canada, energy and utilities are right up there with the financials and banking sectors for distributing hefty dividend distributions to shareholders, and Enbridge is definitely one of the top players here in the energy space for consistently paying out nice dividend distributions to their investors. In fact, Enbridge is actually considered to be a dividend aristocrat, meaning that they have been consistently paying out and raising their dividend distribution each and every year for at least 25 years in the United States and 5 years in Canada. Those are basically the criteria to be a dividend aristocrat in either of the countries, but Enbridge has been doing this for 26 years, making it a dividend aristocrat in both countries. At the current share price in Canadian dollars for the Canadian listed version of Enbridge, and considering the distributions per share, Enbridge has a 7.97% dividend yield, which is fantastic for any dividend portfolio and is why I've personally included it in my own. Now, the energy industry as a whole has been on a rocky road over the course of 2020, being one of the hardest hit industries, and Enbridge certainly wasn't immune to this. Year to date, the stock has tumbled down by roughly 16% at the time of filming this video, which in contrast to the S&P TSX Capped Energy Index, which year to date is still down right around 36%. This shows that Enbridge has actually fared a little bit better than the overall industry. This, however, was as a result of the decline in economic activities over the course of the pandemic, which also had the impact of a significantly lower oil demand, which is the company's main revenue source, and this fluctuates based on demand for and the price per barrel of oil. With that said, the U.S. Energy Information Administration's short-term energy outlook is forecasting an increase in the price per barrel of crude oil up to $49 in 2021, which is up from the average of $43 per barrel in Q4 2020, representing a 14% increase. This is obviously great news for a company like Enbridge because it's going to allow them to increase their free cash flow figures over the course of 2021. In terms of their dividend though, the company did manage to keep it intact and maintain their streak of paying it out as well as raising it year over year, even though for 2021 their fiscal guidance indicated that the increase in dividend distribution would be only around 3.09%. Regardless though, Enbridge is a key Canadian energy player for a reason, with their extensive network of liquid and gas transmission pipelines, gas storage facilities, renewable power generation, and other energy services, all of which we can see here on this map. Now, in addition to this, while the company is primarily built around oil pipelines, it is starting to increase its renewable energy output with currently 22 wind farms, 6 solar farms, and 1 hydro facility, all of which should continue increasing over the years. 12 analyst ratings have Enbridge at a buy right now, with a consensus price target of around $51.60 for the stock over the course of the upcoming 12 months, and this shows a 21.5% potential upside for the stock, which I think is definitely justified based on the projected increase in demand for oil as well as the increase in price per barrel of oil in the upcoming year. All this to say that Enbridge is a great dividend stock to hold in a dividend portfolio for anyone who's looking for a really hefty dividend yield right under 8% right now, and that could also benefit from some nice capital gains over the course of next year. However, I do have to mention here that I am not a fan of this company's dividend payout ratio as well as their dividend to free cash flow ratio, both of which are well above 100%, and in normal circumstances for normal companies, this would definitely be a red flag for me, so I did want to mention that. However, in the case of Enbridge, this is a company that's maintained these very high ratios regarding their dividend for over a decade while continuing to pay out and raise the dividend over time. So even though that is a red flag for this company, it's something that I'm kind of tolerating here. But if you do decide to invest in the company, definitely be aware of this and keep this in mind as an investor. With that said, let's jump right into the second dividend stock in today's list. Alright, so this next dividend stock is a company that I'm a huge fan of for consistent dividend payments over time, as well as capital gains in the dividend portfolio, because they have a very successful telecommunications network across Canada, as well as multiple growing business facets. The company I'm speaking about here is Telus, ticker symbol T.TO on the Toronto Stock Exchange, and TU in the United States on the NYSE. Now, Telus is most likely the company that you're familiar with, as they have an extensive network across Canada and a very large customer base. This is also a company that offers wireless data services, at-home internet, television, hosting, cloud-based services, and even telehealth, which we'll be diving into shortly. Telus is also the parent company of subsidiaries like Koodo Mobile, Public Mobile, as well as Alarm Force Canada. In fact, as of 2019, Telus possessed around 29% of the Canadian wireless telecom market, which was the smallest among the big three between Bell and Rogers, but regardless, this is a massive market at around $70 billion annually, and a 30% market share is still a massive amount of business. Now, other than the fact that Telus has a 4.90% dividend yield right now at the current share price and has been growing this dividend consistently over the past 16 years, making the stock very attractive to dividend investors, they also have great financials and have been venturing into 5G and telehealth, both of which boast promising futures. In terms of their financials, the company has seen increased revenues year over year since 2016, and their trailing 12 months revenues are still showcasing growth, even though their earnings per share estimates have been missed somewhat consistently over the past year. Based on growth projections, however, I do expect that Telus is going to continue increasing their top line for the foreseeable future. This company has also been heavily investing into their assets by upgrading their network infrastructure in order to support a 5G telecommunication, which is going to provide massive value to their customers for increased speed and functionality. 5G is a really big deal, estimated to create 250,000 Canadian jobs and contribute $40 billion to the country's economy by 2026, which is really soon actually, and Telus is looking to capitalize on this massively by implementing a 5G network, and this is going to be accomplished by partnering with Samsung as their network infrastructure provider, which provides world-leading 5G infrastructure. Another interesting business vertical that Telus has ventured on into over the past couple of years is the telehealth space. And if you've been watching my channel over the past couple of months, then you would know that I am very bullish on the telehealth industry by speaking about companies like CloudMD, Well Health, as well as Teladoc down in the United States, all of which I'm a shareholder of. But Telus has their own sub-facet of the business called Telus Health with their app called Babylon, which has over 4 million global app users, which is very significant considering that this isn't a company that was in the spotlight when speaking about telehealth. So yeah, all this to say that Telus has multiple different business verticals and products and services that they offer to their customers, which is consistently increasing over time. This is a go-to dividend stock that I personally have in my dividend portfolio for nice dividend distributions as well as capital appreciation over time. But what are your thoughts on Telus and Enbridge? I would love to know. Make sure to let me know down in the comments if these are dividend stocks that you personally have in your portfolio, or if you hold other telecommunication or energy companies that you think are also great dividend stocks. Moving on to the third dividend stock for today's list that I'm personally going to be holding over the course of 2021 and beyond. I was kind of split here as to which stock to feature in this slot. It was going to be between TD Bank and Algonquin Power, but I decided to go with Algonquin Power, ticker symbol AQN, on the Toronto Stock Exchange and on the New York Stock Exchange, since even though TD Bank is by far my favorite dividend stock in the Canadian banking industry, I recently spoke about them in my video collab with Daniel Pronk on the channel that I'd highly recommend you check out if you haven't already. Algonquin Power is essentially a power and utilities company that owns and operates a pretty broad portfolio of both regulated and non-regulated renewable energy generation, distribution, and utility transmission assets across Canada as well as the United States. The reason why this company is increasingly attractive to dividend investors, though, is because they pay out a nice dividend yield of 3.92% at the time of filming this video. They have a dividend growth streak of 9 years, and their average 5-year dividend growth rate is 9.8%. This is a great dividend stock, and as they continue to grow operations, should be able to eventually lower their payout ratio that's currently at around 70%. This is also in addition to the fact that governments and corporations are looking to increase their consumption of renewable energy over the coming decade and beyond, and in the case of Algonquin Power, around 70% of their income is derived from regulated water, electricity, and natural gas distribution in locked-in contracts. This pretty much means that regardless of positive or negative economic impacts that we see over the coming years, well, Algonquin Power is going to be able to maintain a high level of their revenues since their demand is significantly more stable and constant. Now, one thing I really like about AQN is that even though they have a nice portfolio of assets right now that is generating them nice recurring revenue, they have significant projects in the pipeline, which is going to be able to double their energy output over the coming years as these new assets become built. At the present moment, their hydro, solar, and wind power production is around 2 gigawatts, but they also have an additional 2 gigawatts worth of new renewable energy assets that are being built. This means that as these projects are built over the coming years, AQN will be able to double the power output, and that doesn't even take into account further projects and developments that they're most likely going to be including to their project pipeline. Overall, renewable energy is a sector that I'm extremely bullish on over the coming decades. I think that from here, there's only going to be an increase in demand for this type of green energy. So AQN's dividend distributions, as well as their high potential for capital gains over time as this company and the renewable energy space in general continues to gain momentum over time, is the reason why I've been a shareholder of this company for well over a year. I bolstered my position when the stock corrected over the course of this year at the beginning, and I've continued buying more and holding the stock. I don't see myself offloading this stock in my dividend portfolio anytime soon. With that said, make sure to let me know down in the comments if you're also bullish on the renewable energy space and if Algonquin Power is a stock that you currently hold or are thinking of holding in your portfolio. And finally, the fourth and last dividend stock that we're going to be speaking about in today's video is the Medical Properties Trust, ticker symbol MPW on the New York Stock Exchange, which is actually a real estate investment trust that I discovered while watching Joseph Hoag's video about 5 dividend stocks that he's recommending to buy in 2021. As I mentioned at the beginning of the video, extremely coincidental channel that Daniel Pronk also made a video featuring not only Joseph Hogue, but also this one stock in particular. We had a great laugh about this. But anyways, the video that Joseph made had some great picks for dividend income that I hadn't even heard of before, and I'd encourage you to go check out his video if you haven't already. I'll leave a link down in the description to it, and make sure to let him know that I sent you if you end up doing that. Now, I'm including MPW in today's dividend stock video for a couple of reasons. The first one being that you all know I'm a fan of real estate investment trusts for dividend income, because the business model of a real estate investment trust and the rules and regulations that they have to follow in order to maintain their status as an REIT is that these trusts are forced to pay out a high percentage of their net income as dividend distributions to shareholders. In the case of Medical Properties Trust, this is a REIT that currently pays out a 5.12% forward yield, which is great for any dividend portfolio, and they operate in a real estate sub-niche that is going to continue experiencing heavy demand in the future. As it currently stands, the trust owns and operates 224 healthcare properties across the United States, 153 in Europe, and 11 in Australia. So it's safe to say that their portfolio in healthcare properties is highly spread out and diversified. Combined, these investment properties represent over $13 billion in total market value, which has been growing consistently year over year as the trust continues to acquire more properties, mainly through a sale-leaseback strategy. This is a really interesting strategy in which MPW can go ahead and purchase and acquire these medical properties from the medical companies and then turn around and lease them right back to these companies in question. This is truly a win-win for both parties because the healthcare companies can focus on growing their internal business, which is, well, healthcare, while MPW can then manage the property and grow their balance sheet. What's also appealing about this real estate investment trust is the fact that they focus on the acquisition of medical properties, as well as the fact that they have nice tenant diversity and their lease lengths are quite lengthy. One of the main issues with retail REITs that we saw over the course of 2020 was their tenant resilience to business shutdowns, and then their capacity to then pay rent, but also whether or not the trust would be able to lease out all of their leasable property. Because the main issue with a REIT is that any financial struggles that the tenant is enduring can very well also be conveyed up to the landlord. This is one of the main issues that REITs like RioCan, Smart Centers, as well as H&R REIT for their retail side of the portfolio encountered over 2020. So regardless of the fact that healthcare, specifically primary healthcare, is in prime demand right now and will continue to increase for decades to come, MPW has extremely long and committed tenants. Here are a couple of their tenants, and most of these properties have extremely long-term leases, which is beneficial for locking in revenues and cash flow for Medical Properties Trust. Speaking of revenues, the trust has consistently increased their revenue figures since 2016, and their normalized funds from operations have increased by 49.6% since same period 2019, which is really great to see. So even considering the fact that the real estate investment trust industry was hit extremely hard over the course of 2020, this is a real estate investment trust that has actually thrived and continued to increase their top line even amidst this extremely difficult period. And I know a lot of my viewers had previously asked me in my REIT comparison analysis videos to include a medical property trust, so this is a really great option for that. In fact, when looking at their dividend history, the trust has also been raising and paying out their dividend for over 8 years, which isn't necessarily the longest, but would grant them the title of aristocrat if it was a Canadian stock. And finally, their funds from operation payout ratio is hovering right around 80%, which for a typical company would be extremely high, but in the case of a real estate investment trust, this is a healthy payout ratio in relation to their funds from operations. So yeah, this is a stock that I do not currently hold. However, I am looking at buying into to hold in my dividend portfolio because I also see it showing some nice potential upside over the course of the coming years. Again, if you do want more information about this stock in question, as well as 4 other great American dividend positions, then make sure to check out Joseph Hogue's video on the topic. Alright, so that pretty well wraps it up for today's video, going over 4 dividend stocks that I am personally buying and holding for 2021 in my dividend portfolio. I really hope you enjoyed the picks. If you did, make sure to drop a like, and also feel free to let me know down in the comments which dividend stocks are on your radar for right now and moving into 2021. If you're interested in more content like this, speaking about investing and stock market investing, then make sure to subscribe to the channel and hit the bell button to be notified whenever I release new and upcoming content about investing. So on that note, thanks a lot for watching today's video, and I'll see you in the next one.